Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, U.S. stock futures rebounding this morning after the major averages closed in the red, halting 7 consecutive days of gains for the S&P 500. But the gold rally, it continues to power higher. Spot gold hitting $4,000 an ounce for the first time ever. Billionaire investor Ray Dalio says he sees gold as more of a safe haven than the dollar. He compared its record run to the 1970s, a time of high inflation and economic uncertainty. Plus, Nvidia reportedly investing in xAI as Elon Musk's startup looks to raise $20 billion. Bloomberg News reporting the company is investing as much as $2 billion in the equity portion of xAI's fundraising. The report comes just days after rival AI startup OpenAI announced a blockbuster deal with Nvidia competitor AMD. Nvidia declined to comment on the report. And investors are looking ahead to Fed minutes later today. The commentary will provide investors with insight into the central bank's rate path. It comes at a time when key economic data is on pause amid the government shutdown. While the September FOMC meeting seemed dovish following the rate cut, the minutes could be more hawkish, meaning officials want to keep rates on hold as several governors pushed back on the pace of easing. Let's get a check-in on stock futures here this morning. All three major averages right now pointing to a higher open, but in the case of the NASDAQ, it's a tenuous one, only pointing to a gain of 0.1%. A little bit more for the S&P 500. The Dow right now, the strongest indications of the three major averages. Let's dig into our top stories of the day now. Futures rising after the S&P 500 snapped its winning streak, and investors are waiting Fed minutes out today. Plus, Tesla unveiling cheaper versions of its popular models. Joining me now, senior reporter Brooke DiPalma, live at the NASDAQ, Federal Reserve correspondent Jennifer Schonberger, and senior autos reporter Pras Subramanian. Guys, thanks for being here. Brooke, let's start with you and what we've been seeing in the markets here and the sort of interesting dynamics and the continuing discussion over AI, all of that equaling, a little bit of volatility, but mostly continued push higher.
Yeah, mostly continue to push higher, and we did see the S&P 500 snap that 7-day winning streak, but the momentum continues yet again this morning. The Dow expected to lead the momentum in stock futures this morning, with all three major indices pointing to upward momentum, all expected to open in the green as of now. Now, if you do take a look at where exactly investors are turning towards in this sort of environment where we are expecting those Fed minutes, we're still in a government shutdown, and we're lacking some key economic data about where exactly, the Fed will be looking to go, albeit we do expect another quarter point cut. Investors right now are turning to alternate assets, and we're seeing lots of investors turn to two things, both gold and Bitcoin. And I want to take a look at the YF Interactive because this is largely after we have seen the U.S. dollar come under some weakness. Year to date, the U.S. dollar is down nearly 10%. And so as we've seen this U.S. dollar come under pressure so far year to date, now we have companies or firms like JP Morgan pointing out in a client over the weekend, and we heard some more of this rhetoric on Monday and Tuesday of this concept called a debasement trade. And what exactly that is investors really thinking, okay, government debt is too high, we're seeing inflation rise, and ultimately this confidence in fiat currencies ultimately drop. And so we're seeing investors really turn to these alternate assets, including Bitcoin. And over the past 10 days, this October has really been a strong start for Bitcoin. We saw Bitcoin even soar. If you take a even closer look, we did see it cross that $125,000 mark ever so slightly earlier this week. And now we're expecting to see it open slightly lower this morning, but after such a run over the past few days, soaring from 118,000 to more than 125. In addition to that, we also see investors turning to gold. And gold has had quite the run also. Over the past 10 days, it's up more than 6.5%. And as you noted at the top, this has crossed $4,000 per ounce for the first time on Tuesday. And this is really a record-breaking rally for gold. You don't necessarily always see Bitcoin and gold, these two alternate investments, rise at the same time. But this really does speak to investors seeking out assets that are really resilient to perhaps political pressure that we're currently experiencing, and also potential inflationary pressure as well. And so it's a really interesting dynamic that we're going to continue to watch, especially as we continue to see that flat or weaker dollar moving into the end of the year.
Yeah, definitely. I'm seeing some unusual movements and things moving together. Jennifer, let's talk about the Federal Reserve as well, because we're going to get some Fed speak. We're going to get the Fed minutes and hopefully get a little more clarity, even at a time when we're not getting economic data. So we're not getting clarity on that front.
Well, I think division is still going to continue to reign, Julie. And ordinarily, I would say, hey, the Fed minutes are going to be stale because they're released with a 3-week lag. But given that we are in a government shutdown and that we haven't gotten any new government data, namely that jobs report for September, I think the thinking is still going to hold here. And so I am going to be looking for any clues on the future path for rate cuts, how many more rate cuts we could expect, where different members of the Fed stand on that. And given that we aren't getting much data right here, right now, the Fed is being forced to be more forward-looking, which is something that Fed Governor Stephen Miron has said that the Fed needs to be. And we heard from him yesterday in which he reiterated he wants to get to neutral faster than his colleagues because he thinks that housing inflation is going to come down, which is going to pull overall inflation down. And he's not seeing much inflation from the tariffs. And so he thinks the Fed needs to do some more cutting here. On the flip side, we also heard from Kansas City Fed President Jeff Schmid, who is at the complete opposite end of the spectrum. He is still concerned about inflation. In fact, he pointed to the fact that we are seeing durable goods prices increase. And typically you do not see that. In fact, we haven't seen that with the exception of the pandemic during the past 30 years. Goods prices have actually been deflationary. He also pointed out that services prices have been going up the past couple of months. So prices that we pay for like haircuts or getting our lawns mowed. And so he says that the Fed needs to remain vigilant here. He seemed to imply that he doesn't want any further rate cuts at this point. So I will be looking for more clues on that we are seeing borne out in Fed speak in those Fed minutes later this afternoon. And I expect more of that as we continue to hear from Fed speakers themselves today, later this afternoon, and into tomorrow.
Well, and Jennifer, again, to emphasize, we normally would be getting the next tranche of inflation data next, Wednesday? But if the government is still shut, we will not get it. We didn't get the jobs report. How much do we know about whether the Fed is looking to these same private surveys that everyone else is looking to?
Well, they are looking to it because they're forced to with the dearth of federal government data. And there's also surveys that some of these regional Fed presidents conduct, right? The Atlanta Fed, for instance, leans on some of their surveys. In fact, Raphael Bostic from the Atlanta Fed was out yesterday talking about how he's speaking to CEOs about their future plans on hiring and price hikes. And typically, in his experience, whatever CEOs say their plans are actually come to fruition. That said, we also heard from Fed Governor Stephen Miron, who said, look, private sector data is not a substitute for government data. That is the gold standard. And right now, policymakers can't really make an informed decision about monetary policy without those critical reports. And like you said, Julie, if we get into next week and this government shutdown is continuing, then that is interfering with the data collection at that point. We're not going to get the inflation report if that remains to be the case. And that's also the week in which we would expect the Labor Department to collect and survey hiring and jobs. So then the October jobs report gets impacted. We also have furloughs, which some of these government employees may or may not get paid back, given what President Trump said. We've also had people who've taken the government payouts, who've been on the payrolls for the past 8 months. They rolled off on October 1st. So it's shaping up to be an ugly October jobs report. But again, we're in a vacuum here. We don't know. So there's a lot of question marks.
There are. We're going to keep talking about and looking at some of those private reports. We got to get to the stock story that we've been watching over the past day or so, and that is Tesla. The shares are rebounding a little bit this morning, Pros, after the introduction of its new, cheaper Model Y and Model 3, but they fell about 4.5% yesterday. What's the sort of word on the street about the reception here?
I think it was sort of expected that the new cheaper Model Y would come out. That car starting a shade under $40,000, a decontented version with lighting that's not as complex, cloth materials inside the seats, things like that, a battery that's maybe not as large. So we were expecting that. But one thing that caught people a little bit off by surprise was the cheaper Model 3, which is the sedan, which actually costs a shade under $37,000. I think that's an interesting value proposition for Tesla here as they try to recoup some sales from the loss of the EV tax credit. The question is, Julie, even with these cheaper models, they're not as cheap as the original cars were with the tax credit. So that's a big, I think, issue. That are you going to get buyers that are going to pay actually $2,000 more for a car that's less or just not as good as the past car before? So I think that's the big question for Tesla as we enter Q4 and just sort of this post-EV tax credit world.
That is a really good point, that they're marketing it as a cheaper vehicle, but of course you have to account for the lack of tax credit. Something I have not thought enough about. Elon Musk also busy this morning, reportedly signing a deal with NVIDIA, among others. It's doing a fundraising round, raising about $20 billion, according to Bloomberg, and NVIDIA is a part of that. So Musk's sort of continuing to wear his many hats here and to try and work between his businesses.
Yeah, it's one thing where, he positioning Tesla as an AI company, but also he has an AI company called XAI, right? And so they're raising this big $20 billion funding round with NVIDIA. What's interesting about the NVIDIA stuff, to me, Julie, is, what's it for, right? It's the money to raise equity and debt for a special purpose vehicle that will buy NVIDIA processors and rent them to XAI to use in their Colossus 2 project, which is their massive data center in Memphis. This is the latest deal where we're seeing a chip maker invest in an AI company. That AI company then rents or buys chips from that chip maker, and the money just sort of goes in a big circle. The question is, for me, is where does it all end? How does this circle, this merry-go-round end? Is there going to be sort of a check to be paid at the end? I mean, what happens there, right? So for me, it's really interesting. I mean, the valuations are great for these AI companies. Everyone's happy. The Oracles of the world and the NVIDIA's of the world are very happy to get this, to invest and get the money back in the form of their chip rental. So we'll see what happens. But I just find it to be a little bit not organic in some sense.
Yeah, and that seems to be the concern out there in the market too, because we keep having these fits and starts. Brooke, give us a check on the AI trade this morning and how it's playing out.
Yeah, Julie, the AI trade continues to build on that momentum that we've been seeing year to date. I mean, it's amazing to see. If you take a look at the interactive, NVIDIA expected to move higher. These are extended hours trading. So what we're looking at in the pre-market, NVIDIA expected to lead the gains, up nearly 0.7%. Then you have AMD also expected to open higher after it gained about 3.8% during Tuesday's trading session. Also taking a look at Micron, because that stock also expected to open higher, up more than 1%. After it did see about a 3% decline on Tuesday's trading session. And also, I want to take a look at Super Microcomputer, because that stock also expected to open higher as well. And this really just speaks to the momentum that we've seen year to date of this AI bubble risk that we've been talking about. But yet these equity markets continue to power on based upon the expectations that they'll continue to prove out earnings expectations come those third quarter results, and also these year-end targets that we continue to hear go higher and higher, with even Evercore ISI earlier this week saying that S&P 500 could hit 9,000 by the end of next year, despite this bubble risk within the market. So expected today, the AI trade continuing to power higher this morning. That's what word on the street as of now, with Micron expected to lead the gain in the early innings.
Brooke, Jen, Pros, thanks so much. Appreciate it. Coming up on Morning Brief, we'll bring you today's top trending tickers and count you down to the opening bell. We'll be right back. Now time for some of today's trending tickers. We are watching Verizon, Penguin Solutions, and Jefferies. First up, Verizon, signing a deal with AST Space Mobile to provide cellular service from space beginning next year. The deal aims to bring direct-to-service connection via space to cell phone users when needed on Verizon plans, according to AST. It marks an expansion of a partnership between the two companies that was announced last year. You can see AST shares are up by 14%. Next up, Penguin Solutions. Those shares are seeing a sharp drop after the company's sales guidance range fell short of analyst estimates. The company, which helps enterprises build out AI infrastructure, said the guidance range is wider than usual to, quote, reflect a broader set of potential outcomes. By the way, you can tune into Yahoo Finance's Asking for a Trend today at 4:30 p.m. Eastern. You'll hear an interview with Penguin CEO Mark Adams. And finally, we're watching Jefferies. The investment bank disclosing exposure to First Brands Group. It's an auto parts supplier which is now bankrupt. A fund controlled by Jefferies has $715 million in First Brands trade debt. Jefferies' investment in that fund, along with some First Brands loans, brings its total exposure to $161 million, according to the bank. The disclosure reveals more about Jefferies' ties with First Brands, which filed for bankruptcy last week after a debt refinancing was derailed by investor scrutiny. Jefferies had been marketing the refinancing for the company, and many of Wall Street's biggest names have faced losses on their exposure to First Brands. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, 6 months since the Liberation Day tariffs sent markets to lows, the S&P 500 has surged by $16 trillion in value, but a slew of what are being viewed as circular deals among the top AI names, including new reports of NVIDIA investing up to $2 billion in XAI, have spurred concerns about a potential bubble forming. Joining us now, Kevin Gordon, Charles Schwab Director and Senior Investment Strategist. Good to see you.
Hi, good to see you, as always.
Kevin, we were just talking about Jefferies' exposure to First Brands.
Yeah.
And one of the analogies I've seen in all of this AI financing is to retail financing in some cases, right? Where you're extending loans for merchandise that someone is buying from you,
Yeah.
right? But we're talking about huge companies that are involved in it, in the AI space.
Yeah, and I think that is a big distinction, especially because, you know, the knee-jerk reaction for a lot of investors and analysts today is to draw comparisons to the late 90s. That's really the only historical analog you have when you involve something like tech or anything internet related. So I think that that's warranted in some cases, but I think that if, to your point, you look at some of the earnings profiles for a lot of the large companies that are involved in this, there is inherently more of a fundamental underpinning to a lot of this. That said, doesn't mean that prevents any kind of bubble-like behavior or speculative fervor. There's still a lot of that you could argue that is happening. I do think that there are even important distinctions if you just back this up a couple of years ago, where, you know, a lot of people have expressed concern around things like 2021 when you had that speculative craze that was concentrated in SPACs, concentrated in meme stocks. But again, those were less profitable, if profitable at all, portions of the market, and collapsed in spectacular fashion, but didn't send the S&P down that, you know, in a serious correction. Of course, we had a bear market in 22, but that was arguably unrelated. So I think there are enough distinctions, but the overarching theme that we've sort of been emphasizing is that even though the earnings share of a lot of these larger companies in the S&P has grown significantly, that doesn't take away the risk that they still pose from a concentration perspective. Because you can have earnings for those companies slow down, you could have expectations get too far ahead, and if they don't outperform, then you could see some pretty significant corrections. So there's something to be said there about that.
Well, it's so interesting too, because we've seen obviously a lot of money go into gold and Bitcoin, and it's been put down to concerns over the US dollar, but you have to wonder if it's also just like hedging in general against this stuff too.
Yeah, I don't fully, buy that it's a bet against the dollar, or buy that narrative that it's a bet against the dollar. Not just because the dollar's actually started to turn over the past couple of months and has been somewhat stable since gold has really taken its most recent leg higher, but also you've had other currencies that have weakened, notably in Japan recently, presumably related to all the prime minister news, but then also even in Europe, there's been a little bit of softening there. So it's not just a dollar story. Plus, when you look at the stock versus flow aspect of the US dollar, yes, the flow may be under pressure this year. That's also coming off of a very strong level, coming into 2025 when a lot of people were more exposed to dollars. So there's enough of, I think, a story, again, back to fundamental underpinnings, I think there's enough of a strong story there for the dollar where maybe gold is not directly related to it. To me, I think there's probably more of that built-in now political or geopolitical risk premium, probably more domestic political risk premium now for the US, but also around the world. Trade involves virtually every corner of the world, and also labor policy is impacting multiple parts of the world in terms of who our biggest so where do our biggest inflows come from an immigration perspective?
So to take a step back and talk about the strategy around this, what gold does reflect is that desire for diversification, right? And that seems to be, I know you're interested, or you're emphasizing diversification, and that really seems to be, it's always a buzzword, but it seems like even more so right now.
Yeah, and I wrote in a note this week, it sounds so boring, but sometimes boring is good. And I think that at these times when you get really caught up in a lot of these trades where you see individual stocks or certain industries that are surging by double or triple digit percentage points, yes, the knee-jerk reaction is to think, oh my gosh, I've missed a rally, or why am I not in that portion of the market? But then vice versa, when things do start to go south and when you get that unwinded momentum, there are times then when you get a little bit too skewed to one trade, or that becomes too much of a portfolio. So really diversifying away from that, not completely outside of it. Staying invested is a powerful thing, but diversifying outside of that it can also be a powerful thing. And I think a good example, and again, not to harp too much on the late 90s and the early 2000s, but a good example of this is the first couple of years of the bear market from 2000 to 2002. If you looked at the equal weighted S&P 500 in the first couple of years, it was actually unchanged. Yet the cap weighted S&P 500 was down by almost 50% at that point. So not to say that that's an exact outcome this time where that trade will completely be replayed, but at times when you get to this pretty extreme concentration, when the 10 largest stocks in the S&P 500 are almost 42% of the index's market cap, which is way higher than where we were in March of 2000, those are the instances where it makes a lot of sense to step back and say, where am I too exposed outside of what I'm normally comfortable with, or what I've set as my allocation?
And just quickly, sort of besides concentration risk and the AI trade, what's the other big risk that you're concerned about in the market?
I think what looms actually, and I don't think it's necessarily this Armageddon risk, but I think that from a tariff standpoint, it seems that that's taken a little bit of a move to the back burner in multiple aspects. And I would highlight two, the first one being, of course, whether the IEEPA tariffs specifically are deemed illegal or not, because if they are, there's a lot of logistical headaches, I think, that would come from that in terms of refunding companies, but then the administration potentially exploring other avenues to go down and to explore to put those tariffs back on, or at least keep the effective tariff rate high. The other aspect, though, I think, in coming up in earnings season, which fortunately we'll be able to get more clarity in the coming weeks, but just the meat on the bones that companies are going to now put on when it comes to what their pricing plans are for what they're going to do with tariffs and how consumers respond to it. This is a very different time for consumers to respond to higher prices, especially because of how fragile and soft the labor market is. So I think those two aspects are underappreciated.
Don't sleep on tariffs.
Don't sleep on them.
I like it. Yeah. Kevin, thank you.
Thanks,
Appreciate
Julie.
it. Good to see you. Well, coming up on Yahoo Finance Opening Bid, executive editor Brian Sazzi, the host of that program. Saz, what's coming up?
Yeah, Julie, we're going to dig more into this Goldman no bubble call research note. Great way to start my day at like 3 a.m. finding a note like this. This is like a gold mine of content for me. Also, Constellation brand CEO Bill Newland's coming in. Company reported this week, sales down in the wine and spirits business. So lots going on there as people just drink less, Julie.
I hope you're listening to the music I sent you to get pumped up, Saz.
Never. I'm never listening to anything you send me ever. In fact, I need a drink after listening to the stuff you send me.
Listen to what I just sent you. You're going to like it, I promise. All right, that does it for Morning Brief. You'll see Saz all pumped up next on Yahoo Finance from My Music.